My view is that the world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second, we know the definition of a recession. The technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research are the unofficial but widely followed referees on when you're in a recession and when you're not. Well, we're in the expansion. The expansion started in June 2009. So wait a second, how can we be in a depression if we're in the 10th year of an expansion? And the answer is that people don't really understand the definition of a depression. They assume intuitively, well, if a recession is 2 quarters of declining GDP, and a depression sounds worse, it must be 6 quarters of declining GDP. Well, we haven't had that. But that's not the definition of a depression. The definition of a depression is a sustained period of below trend growth, with no particular tendency to collapse or getting back to trend. In other words, I'll use the United States, but you can apply this more broadly to the world. If trend growth is 3.5%, and that's probably the long-term potential of the United States, you can higher nominal growth with inflation, but we're talking about real growth. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth, you're not in a technical recession, but you're in a depression because you're not getting back to that trend. And people say, well, 2%, 3%, it's 1 percentage point, who cares? No, that gap is huge. And because of the compounding, in fact, think of it as a wedge. Here's the trend line, here's the actual line, that wedge gets bigger. So we're 10 years out, we've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. But being objective, using the numbers I mentioned, we're in a depression, we're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their 3rd lost decade. If something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. But now the Fed has a dilemma, which is what are they going to do if the U.S. economy goes into a recession? As I said, we're in the 10th year of an expansion. The old cliche, expansions don't die of old age, is true, but they do die. And history shows that it takes about 4 percentage points of cuts, 400 basis points, in other words, for the Fed to get the economy out of a recession. Well, how do you cut interest rates 4% if you're only at 2%? The answer is you can't. You cut them to 0 and then you're stuck. You're at that 0 bound, and the evidence is good that negative rates don't work. So then what do? We're going to print some money again. Modern monetary theorists would say, yes, I disagree, and I think the Fed disagrees, as shown by their own actions in trying to reduce the balance sheet. So what the Fed is doing, they're trying to raise rates to 3-4%, trying to get the balance sheet down maybe $2 trillion, a little bit less, so that when the recession hits, they can run the playbook again. They can cut rates and, if necessary, do QE. But here's the dilemma. Can you normalize interest rates and normalize the balance sheet without causing the recession that you're preparing to cure? That's the conundrum. I think the answer is no. I think that actually in trying to tighten to get ready for the next recession, they're probably going to cause the recession. There's no data, there's no time series that tells you how this is going to play out, except during QE, what did we see? We did not see a lot of inflation, but we saw asset prices blow up, stocks, real estate, other asset categories. They all went up a lot. So it seems, at least kind of first order intuitive, that if you print money, asset prices go up. If you destroy money, asset prices are going to go down. So what the Fed is doing, they're destroying money, reducing the money supply. So they're really double tightening. In addition to the 4 rate hikes a year, this reduction in the balance sheet is probably equivalent, this is an estimate, probably equivalent to 4 more rate hikes per year. So they're actually tightening at a tempo of about 2%. Probably going to throw the economy into recession. The Fed has never forecast a recession. They have a terrible forecasting record. This will happen before they know it. Of course, we all know that stocks will go down. So based on that, I'm not bullish on growth. I'm bearish on stocks. People say, well, gold hasn't gone up a lot. It's true. I'm surprised it hasn't gone down more given the tightening environment that we've described. So gold has actually performed fairly well given the environment. Now, what I do expect is in time, as this signs of recession emerge, yield curve inverts, growth slows, job creation slows down, not a full-scale recession or crash, but just enough warning signs, and the Fed reverses course. All of a sudden, they do pause at one of these meetings. Gold's going to skyrocket because that's an admission. At that point, the Fed's throwing in the towel. They say, you know what? We really can't escape the room. We can't get back to normal because when we try, we sink the economy and we have to back off. And that's when gold will shine, no pun intended, because it'll be very clear that the Fed cannot get out of this easy money mode. One thing I never do, I never make a forecast or make a claim without backing it up. There are people out there that are a dime a dozen, this is going to crash or this is going to go up or growth is great or it's so whatever. That's fine, but you need to back that up with some kind of analytics, some kind of data, some kind of analysis that you can do. And I always do that, and I'm always happy to kind of drill down on that. So the methodology I use is quite different from what Wall Street forecasters use. First of all, I'll just spend a minute on what Wall Street does and what most analysts do, because it's badly flawed. It's no surprise that, every year the Fed does a one-year forward forecast. So in 2009, they predict 2010, 2010, they predict 2011, so on. Same thing for the IMF, same thing for Wall Street. They are off by orders of magnitude year after year. I mean, how can you be wrong by a lot 8 years in a row and then have any credibility? And again, the same thing with Wall Street. You see these charts. The chart will show the actual path of interest rates or the actual path of growth. And then along the timeline, which is the x-axis, they'll show what people were predicting at various times. The predictions are always way off the actual path.